Southwest Mississippi Community College in the Workforce Department in the Berry Building, and I'm a Workforce Training Coordinator. Today I'll be your facilitator. We will get started with Mr. Chad Lindsey, his financial advisor that's been with Raymond James Financial Services for 17 years and serves on the Executive Council of Raymond James Financial Institutions Division. He has a finance degree with a second interest in accounting from the University of Southern Mississippi. Chad lives in the Thompson community of Amite County and is a graduate of Centerville Academy and Southwest Mississippi Community College. He and his wife Betsy have 3 children, Ethan, Ruth, and Wickers. I'm going to turn it over to him, and I will tell you when we finish, there will be refreshments out where you register. So, thank y'all.
First of all, thank y'all for coming in here. I've been kind of taking a survey around the room. Did anybody drive further than from Crowley, Louisiana? How far did y'all drive this morning?
3 hours.
About 3 hours. Anybody further than that? 2? Racing. You know, we've got folks here today that from obviously 3 hours, 2 hours away. We had no idea when we started this thing back 2 months ago how far would outreach. You know, Burnell mentioned how this all came together. He and I were sitting down talking, and you know, what really got the brainchild, what really planted the seed to do something like this. I was meeting with one of my clients in Amite County, and it's a lady that I've known my whole life. I've been a financial advisor for the last 7, 8, 10 years. She calls me and says, "We need to talk." And I said, "Great." And I go down to her house and we're talking, and I knew she had some oil interests, and I knew that was probably the discussion we were about to have, which was great. And we're sitting there talking, and she says she started getting checks. You know, I'd done my research. I knew there was she had some acreage under a well that was producing. And she says, "I don't know what to do with it." I said, "Well, obviously, you call me. We're going to figure it out. We're going to get there together." And I said, "What have you done with it?" And she said, "They're on the shelf." I said, "What do you mean they're on the shelf?" And she walked in the bedroom and poured off her shelf 5 checks that she had just been stacking up. The smallest was about 42 grand. The largest was above that. And they were just sitting on her shelf. And after that meeting, which we got her taken care of, but after that meeting, the next week I went and saw Burnell. And I said, "Mr. Burnell, I don't know how many folks are in this situation." Her bills were fine. She's retired. She's places paid for. Now she's got all these extra assets coming in. And she's never been in a situation to where there was that much liquid money. You know, it's one thing to manage assets, but when you're handed a bunch of cash and you're told, "Okay, it's yours, now go to something with it," you know, what do? Where do you go from there? And that's kind of how this all started, was to have more of an informational type conference. You know, not really a lot of sales. We're going to have some sales in here, obviously. Every presenter here today is hoping to get your business. So don't forget that. But hopefully you can take something away across the day that will help you make decisions in the long run. Even if the only thing you take from it is the fact that when you do find someone you want to deal with, make sure it's someone you trust. Make sure it's someone that you can have a conversation with. Make sure it's someone who you think is credible enough to handle your business. Because we're all bridge builders, so to say. We figure out where you are, we figure out where we're trying to get to 3, 5, 10, 15 years down the road, and we find the easiest way to get there. You know, for some folks it might be bonds. For some folks it might be stocks. For some folks it might be neither. I mean, you know, there's worlds of investment opportunities out there. And it's just sitting down with an advisor and figuring out where you are and where you're trying to go with these assets. But that little lady really concerned me when I was there. And she's fine, and you know, not concerned from the worry standpoint, but concerned for the general standpoint of, you know, it touched me that we needed to do something like this. And it touched Burnell also, which is why he's put this together. But in a nutshell, that's how this AICM got planned. That's why we put this on. Now, with that being said, I am Chad Lindsey. I am from the area. I lived in Hattiesburg for about 10 years and had an office over there. Loved Hattiesburg, started having babies, and when you have babies, and it's as much concrete as it is in Hattiesburg, you have to bring them home. They needed to be in the Smith County dirt. I wanted them to grow up like I did. And I feel blessed to be able to be in this community. And when I mean this community, South Mississippi, North Louisiana areas, and not really North Louisiana, but north of the boot, around the laces, and Louisiana people know what I mean by the boot. But at the same time, we have to be diligent with what, as Burnell said, with what God has given us. And the fact that y'all are here means y'all are taking all of this really serious. We've also, Burnell and I have discussed it, we also have clients that are doing exactly what he said not to do. I know other folks that have gotten their checks and went and blew them and have bought other pieces of property and went in debt based on the fact that they expect that check to stay as large as they first got it. I hope it does for them. There's a 98% chance it's going down. And, and that's just the way that oil plate works. Now, if they bring in another well on their land, it can jump right back up there, but it's going to slide back up. But in this room today, we're going to talk about the freedom accounts with Raymond James, okay? What our freedom accounts are, and Mike's going to get into that in a second. I'm going to introduce him and let him actually walk through the breakdown of it. When you're dealing with investments, there are lots of different ways to invest. If you buy regular mutual funds, you can buy A shares, B shares, C shares. A shares are upfront loaded funds to where you pay a fee to get in them. B shares, you don't pay a fee to get in them, but you have to stay in them for X period of time, or you have to pay a commission if you get out of them. C shares charge you more yearly, but you have to stay in it only a year. It all kind of gets confusing. At Raymond James, we did away with all that. And we set up a situation, we've always had an extremely intense mutual fund research department where they broke down mutual funds and they said, here are the best funds out there. Well, the problem with that, if you pick up Money Magazine right now and you see what are the best mutual funds out there, in 6 months from now it'll be a whole different list. When you buy mutual funds, you buy them for the long term. You don't buy them for the next 6 months. So what I want to do is call Money Magazine and say, 6 months ago you told me this was the best fund. Now you're telling me this is, except I paid to get in there. So you can't get out and get in this next one. Money Magazine's trying to sell magazines. They're not trying to give you financial advice. But we took our mutual fund research department, got deals with all of these mutual fund companies to where we can buy all these funds as no-load funds now. And we bundled it all into a portfolio called our freedom accounts. We can go from extremely aggressive to extremely conservative inside of these accounts. No upfront cost, no cost to get out. There is a management fee on it that depends on how much money it is. It gets lower, it gets higher, but the more money it is, the lower it is as a percentage. And if one of these fund managers isn't doing his job, or we'll use Bill Gross for an example. Anybody ever heard of Bill Gross? Bill Gross is the #1 bond manager in the world. He's been with a company called PIMCO forever. He's the best one. He's the best. No doubt he's the best. We've got clients that own the PIMCO Total Return Fund. He's been the best for years. Unbelievable guy. As of today, the news hit this morning, he has left PIMCO. He has quit. He's gone. So when I get to the office Monday morning, first thing I'm going to do is call all my clients, and we're getting out of that fund. Because if they stay in that PIMCO fund, I don't know who the manager's going to be now. It's not going to be Bill Gross. It's not going to be the guy that we want managing their money inside of that mutual fund. So I'm going to have to call these folks and get them out. Inside of these freedom accounts, I don't have to worry about that. Because if there's a PIMCO fund inside of these freedom accounts, I can promise you they're fired immediately next week, and they're going to replace them with somebody else at no cost to the client. And so one of the really good things I like about the freedom accounts is we're able to build a all-star team of fund managers inside of here and keep that all-star team in place. One analogy that I like to use is football. Who won the national championship last year? Anybody know in college football?
Florida State.
Florida State. Does Florida State have the best tight end in the league? No. No. Questionable whether or not they have the best anything at any position, but as a team, they won. Okay? So what we're trying to do here is build the best at every position, even though there might not be the best quarterback on our team, might not be the best kicker on our team, but we put the portfolio together to where we're trying to minimize our risk and maximize our income. I'm going to turn it over to Mike. This is Mike Heyman. He is a regional vice president from Raymond James. I bring him in to let him do the heavy lifting sometimes. And I'm going to turn it over to him now.
Appreciate it, Chad. Thank you all for taking the time. I'm going to spend the morning going over the process we use that Chad described a little bit.
Okay, I'll just wait.
I might drink it, man. I don't know. Had to get up 4:30 this morning and drove from Gulfport, so I might need that. But I really want to go through the process a little bit because there's some things about this Freedom portfolio that truly makes us unique versus all the other firms out there. A lot of great firms out there. I'm not sitting here to say, you know, Merrill Lynch or blah, 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 other firms don't have other great portfolios, but there's truly something unique about this portfolio, which I'll explain as we go through this, that hopefully you see the value in. And let me start with one question for the room. I don't care if you're investing in stocks, bonds, baseball cards, cars, stamps, land. What is the one absolute certainty when you invest that you're going to make money? You do what? What's the absolute, secret? It's a secret to investing. You can never, always works no matter what. You buy low, you sell high, right? Is that real estate? You buy low, you sell high. Well, that's what we're trying to do here, and that sounds great, and that's really, it's like, oh, well, yeah, everyone knows that. You buy real estate low, you sell high. Problem is, it's really hard to do. Because if any of you in this room watch, I don't care if it's CNBC, Fox News, Fox Business, whatever, they're going to get on TV every day and try to scare the heck out of you half the time. The world's coming to an end. I've been hearing that for years, although the market's 3% off an all-time high, but the world's coming to an end. Heard that now forever. And so you got to separate the noise sometimes. And, we put together a process that makes you buy low and sell high and take advantage of the market that you probably wouldn't do on your own. And I'll explain that as we go through this, how we're able to do that. Please ask questions as we go through this if something doesn't make sense. But this is updated through 2013. Just want everyone to know, everyone has this presentation, the average equity investor for the last 20 years has done 5%. Okay? Whether you think that's good or bad, that's what the average equity investor has done. Hopefully everyone in this room knows you can buy the S&P 500. Index funds, things called ETFs, exchange traded funds. You could have just bought the S&P and made 9.22% a year. Is there anyone in this room right now who wouldn't happily take a 9.22% a year return? Okay, well, that's okay. Most people think that's a pretty good return. But that is what the equity has done for the last 20 years. We've had three very good markets in there. A bad market from 2000 to 2002, and then of course what happened in 2008. So a lot of different markets make up those returns, but you could have just bought the S&P and you made 9.22%. However, the average equity investor made 5%. Okay? And hopefully we'll see why in this next page. Let me pull this out because I'm colorblind. I'm going to need to see this. Everyone remember back in 2000, the tech bubble? Everyone remember that? To Chad's point, you open up Money Magazine, there's going to be just a bunch of advertisements for every tech fund, growth fund, telling you to buy Yahoo at the time, Cisco Systems, blah, 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 and so forth. Okay? Because they're trying to sell magazines. And they're also selling greed. So if you look at, here, go to this chart, 1995. It's gold right here. You'll see large cap growth stocks. Those were the Cisco Systems back then. The every .com company, even if we didn't know what they did. EPEX, everything.
WorldCom.
WorldCom, there you go.
Who all knows the WorldCom story?
Okay.
Yeah.
So 38% in 95, 96, 24%, 97, 38%, 98, 42, and then the following year it did 28%. Everybody wanted growth stocks in 1999. You couldn't sell. If anyone remembers this conversations, you used to hear a lot of terminology back in early 2000 about what were called old economy stocks and new economy stocks. All of a sudden, Warren Buffett got stupid. You don't want to own any companies that have cash flow and make a ton of money. You want to own everything related to the internet because that's the future and that's what you got to own. That's what they were selling on TV. They were selling you hype, they were selling you greed. Well, what happened? Well, you lost 2000, you lost 22% in large cap growth. Then you lost 13% almost in 01, and then the following year you lost 24. So if my math is any good, if you held on to large cap growth stocks as a sector, you lost about 2/3 of your money. Okay? So the problem is, and I'll show you on the next chart, here's what happens. We call it trend chasing behavior, and this is on this chart is everything we want to avoid and what this process is trying to get every investor to avoid trend chasing behavior. 2000, $188 billion went into equities, mutual funds, in 2000. You couldn't give bonds away. In fact, money was coming out of bonds. That's the grayish line there. 30 billion came out of bonds. Who cares? Who wants fixed income when I can make 30% a year in the market? It's stupid. Well, of course, you can see the next couple of years, the S&P lost 12 in 01 and 22% in 02. And of course, look what bonds did. Bonds made 8.5% and 10% in 2002. The biggest misconception about the stock market from 2000 to 2002 is how bad it was. There were actually a lot of places you could have made money. Real estate, bonds, what are also called small cap companies, which are just generally really small companies, actually fared pretty well. And you could have made money in a lot of places. The problem was everyone owned 5 growth funds. I remember talking to a friend of mine once, and he's like, I'm diversified, and he owned 5 different growth funds. I'm like, that's not diversification, you own the same thing 5 times. Okay, so you learned your lesson, 2002, nobody wants stocks anymore, hardly. $30 billion goes into stocks, all the money's going back into bonds. $120 billion back into bonds. Because bonds are now the place to be. I learned my lesson. Well, of course, 03 stocks did 29%, then 11%, and bonds did 4% a year. And 08, same thing. You couldn't give stocks away. Best buying opportunity of your lifetime was in March of 2009. In this room, if you were to ask yourself, honestly, March 2009, did you feel really good about investing in the stock market with everything going on? Probably not. And nor did myself and my wife, and you know what I did? Religiously, all throughout 2008, 2009, I was continuously pouring money into the market every day the market dropped. Because I was buying low. Okay? And I'm not going to go read all this, but all this says is what happens is the average investor chases about what's hot in the market. They do just the opposite. They buy high and sell low. Let's not do that anymore because that's why you're going to get to 5% a year. That's what we're avoiding. So we needed to put a process in place to say, okay, how do we keep the average investor from doing this? Because it's hard. It is. So we said, who gets it right? Large institutions get it right. Colleges, foundations, Taft-Hartleys, a lot of these different organizations, they have figured it out. If you look for the last 20 years, the average return for an institutional account, and that on here is called total fund sponsor, that's just an average of those 4 right there, has done 8.16% a year for the last 20 years. Again, the average equity investor has done 5. So just ask yourself this question. For the last 20 years, if we could have given you over 3% a year more of return, a year, 3% every year compounded for 20 years with the same or less risk than the market, would that be compelling to you? Now, the 8.16% return, you know, man, that might not be, you know, you say that the return to the S&P 9.22. Someone once asked me, it was a great question, because I'm sure you were about to ask me that. It was like, well, Mike, this 8.16% is great, but why don't I just buy the S&P? It did 9.22%. And the answer to that question is, from 2000 to 2002, if all you owned was the S&P, you lost 50% of your money. Can you sit here in this room, and maybe some of you can, tell yourself if that's all where all your money's invested, are you not going to sell when you've lost half your money in 3 years? Most people will say no to that. They're not going to do that. Because a simple math problem here, if you're not familiar with this, if you lose 50% of your money, you have $100,000, let's say. You lose 50%, it goes down to $50,000, right? Everyone follow me? How much do you need to now make to get back to where you started?
Over 100,000.
You need to make 100% back to break even. So what the whole point of this process is, we're going to try to minimize the downside. In 2008, you would have lost money. I'm not sitting here saying you can't lose money in these portfolios. Please understand that there's no secret sauce to investing. No one in here is telling you I can time the stock market and have the crystal ball. I'll be the first one. I'll give you my opinion. Doesn't mean it's right. Just ask my wife. She'll be the first one to tell you that. She's like, you don't know nothing about anything. But, so, what we want to say is, let's put a process in place that tries to emulate what institutions do and get that return that's over 3% better than the average investor, and let's do it with less risk. That's the premise of what we're trying to do. And, you know, obviously, we needed to come up with something that we think was unique and give us some resources to help us accomplish that. So, this next chart is probably one of the most important charts and also one of the most misunderstood charts that we have. I know we all watch Kramer. Well, I don't watch Kramer. Anyone watch Kramer? All right, we do.
Right, entertainment.
Yeah. Do you want me to rip on? Want me to give you some Kramer stats or not? You just don't want me to ruin it for you? Or I can. Anyway, there's some good articles on Kramer that will. He's a very smart gentleman.
You got to roll up your sleeves.
But booyah, right? Yeah, I got to do the old booyah thing. There's been multiple studies done in Jim Cramer that the best way to make money on Jim Cramer stock picks is to short every stock he tells you to buy. If you're not familiar with what that means bet against every stock he tells you to buy. Northwestern University did that study. And then Barron's Magazine did a study and said if they, you can Google all these, I'm not making these up. If you bought every one of his stock picks over a 2-year period, you underperform the market by 16% a year. He's the most widely watched show on CNBC by a matter of 2 times. Doesn't mean he's not smart. He knows a lot of stuff about a lot of companies. But he's not doing any financial planning. You call him, hey, Jim Cramer, I want to buy Exxon stock. Should I buy it? Yes, no, whatever. He didn't ask what's your risk tolerance, how much money do you have invested. He didn't ask all the questions that would be pertinent to whether that would be a good investment. He's just telling you buy Exxon. That, may or may not be a good choice depending on your situation. So if you watch Kramer, that's fine, and you find him entertaining, that's great. My dad's retired, he watches them. When I play golf with my dad, he knows how to get me to put my ball, shank my ball in the woods. I'll be on the tee doing my little waggle. He's like, yeah, I was watching Jim Cramer last night, and he said I should be buying Pfizer. He just knows my blood starts to boil, and sure enough, my ball goes in the woods. Every time. So anyway, it's one of my teams. All right, so this is what I call the sleep at night chart, right? Does everyone in this room worry about money at all? Worry about your money? I do. Okay, we all do. It's important to just retirement, everyday living, and so forth. Well, if your portfolio is doing this all the time, huge gyrations and volatility, that makes it kind of hard to sleep or makes you worry about money more, correct? Asset allocation decisions. How you build a portfolio. How much bonds do you own? How much stocks you own? How much large cap, real estate, gold, you name it, commodities, everything 92% almost of the volatility of your portfolio comes down to asset allocation, how you build your portfolio. It has almost nothing to do with what you hear on TV. Market timing, basically irrelevant, and nobody can time the market, so let me just say that right now. Stock selection, a whopping 2%, so Kramer's whole 1-hour show has almost nothing to do with controlling the volatility in your portfolio. Again, I'm saying volatility, not performance. Hopefully everyone is understanding that. And then whatever that other is, it's 1.8%. So for those of you who worry about your money and the volatility of your money, it's very important that you understand the amount of volatility or risk that you're willing to take. And I know Chad brought some investment policy questionnaires that if you're not familiar with what your risk tolerance is, I certainly would take the time to fill those out because you know, they'll generally tell you, you know what, maybe you're riskier than you thought or you're less risk averse than you thought. And times change. You know, kids get married, kids go to school, start planning on retirement. Those things change over the years. So, important chart, one of the most famous charts that we use in our industry. It's called the Brinson v. Bauer study. But asset allocation is everything when it comes to controlling the volatility of your portfolio. All that other stuff that you hear on TV is noise. So what do we do? That's different. You know, I say, you know, again, no one's got the secret sauce. Hate to say it. But we do have a competitive advantage. And we're the only firm that has this. There is a firm called Mercer. They are the world's largest institutional consulting firm in the world. I know I just said that twice. They are owned by a publicly traded company named Marsh & McLennan, who's based out of Chicago. Here is Mercer's client list. I'll give you some names. Pepsi-Cola, Walmart, GE, St. Luke's Hospital, Southwest Airlines, and so on and so on and so on. It's a who's who's list of Fortune 500 companies that hire Mercer to essentially asset allocate or build this. How much money should I have invested here, here, and here? And why do people entrust Mercer? Does everyone agree that we're now in a global economy? Correct? What happens in Europe is very much a factor. What happens here, what's happening in Russia, you know, obviously in some of the Middle East regions as well, where, you know, obviously a lot of energy as well, things like that. Everything has an effect. Look at all the resources they have. 2,000 plus employees. They have clients in 41 countries, 56 investment consulting offices worldwide, so obviously not just domiciled here. And again, they have almost 4,000 clients globally. They are the 800-pound gorilla in the consulting space. So we said at Raymond James, we want this as a resource. And I'll tell you what that resource is, what makes us unique. We're the only firm who has it. The good news for everyone in this room and the bad news, any one of you can call Mercer directly and they will asset allocate your portfolio for you. The bad news is you need $20 million for them to take your phone call. But, you know, they'll take it if you got them. But that's Mercer. We're the only firm who allows you to utilize their resources. You can do it for as low as $50,000 with Raymond James. So, what does Mercer do? Oops. Where was I? Right here. Okay. We have a 4-step process. And step 1 explains what Mercer does, and I want to spend a little bit, probably the majority of the time here on this. Because this is what makes us unique and our process unique. Everyone has a process, but too often in this industry, when you listen to all the ads on TV, and you read Money Magazine, you read Fortune, are they looking in the rearview mirror or are they looking forward? When you see all those ads about mutual funds, what are they showing you?
Past performance.
Past performance, that's right. Do you think the managers that have had mediocre performance over the last couple of years are advertising in those magazines? No? Well, so what's been in favor for the last couple of years? I'll pull this out. Last year, the best place investors were called small cap growth stocks. Okay, these are small companies that have high growth, earnings growth. I'm going to go on a bet and say if you open up a Money Magazine, you'll see some advertisements for that. The worst place to invest last year was emerging markets. was actually negative last year when the S&P was up 32% last year. Probably not going to see a lot of ads on emerging markets. You know what Mercer likes right now? Emerging markets. Because they're really cheap. Historically, very, very cheap. So what we do is Mercer takes every single asset class. They look both in the short term, the next 1 to 5 years, and they look long term. And they say, if you look back in history, I'm talking, you go back to 1920, and you can say, here's the average returns that you should expect for owning certain asset classes. If you go back to 1920, you should generally expect to make more owning small companies than large companies, but they have more risk. Again, however, today, small cap is one of the most expensive it's ever been in the history of small cap. So what we did at Raymond James, and for clients who own the Freedom accounts and clients of Chad's, earlier this year, the majority of our portfolios, we sold small cap. Not completely, we still own some. But we sold small cap. We started buying emerging markets. So let me get this straight. Emerging markets were down 2% last year and small cap was up over 40%. What did we just do?
Buy low, sell high.
That's right. That is so hard to do because you read the noise, emerging markets, here's what's going on. By the way, year to date, small cap is down 2%. Emerging markets are up 8% for the year. You buy something when it's cheap. You don't buy large cap growth stocks in 2000 after they returned 40% a year for 5 years. Okay? Real estate. Freedom's been around since 2002. 2007, I live in Florida, which was the epicenter of the collapse that went on. We sold out of real estate completely in all of our Freedom portfolios in 2007. There were clients calling up saying, why don't we have real estate? It's the best place to be. I used to hear things like, real estate can never go down. When you hear things like that, move elsewhere. Let's sell. We did. We sold at high. We sold what are called high yield, below investment grade bonds, if you've heard the expression, sometimes referred to as junk bonds. Actually, historically, a good place to invest. We significantly sold out of those in 2007 because they were the most expensive they'd ever been in history. Okay, we were taking risk off the table and buying things that looked more attractive. And we do that all the time. You don't have to do anything because if we left it up to the individual investor, it's just what's called behavioral finance. It's hard to buy something that has been stinking for so long and you want to put money in something that's doing great. You know, one of the and these are probably down here in Mississippi, we have them in Florida. You have those shops that buy gold. You got a guy on the side of the street, we buy gold. That's probably a sign that gold's not the greatest place to be at that time. And sure enough, the market did 32% last year. Can't remember if it was 2012 or 2013, but gold lost 28%. Okay, those are signs of bubbles, and we're trying to protect you from that trend-chasing behavior. So what is Mercer like today? And what are we doing in our portfolios today? We're buying emerging markets for clients who are willing to take risks. Chad says we have a variety of different portfolios. If you're conservative, and you're in our most conservative portfolio, you know how much emerging market exposure you have? 0. You said you're conservative. Emerging markets aren't conservative. But we think you're going to make great returns there for the next 5 years. International, developed. Companies like Nestle, Total. These are companies that if they were here in the United States, they would look exactly the same as they are overseas. They're huge. These behemoths. They're extremely, extremely cheap right now. So what Mercer likes? They like that right now. What is Mercer not like right now with interest rates where they're at? Anyone want to take a wild guess? Chad got it right on the first guess. Bonds, right? When interest rates go up, and they will, I have no clue when. I've been wrong for 3 years now, so I'm not going to guess again. When interest rates go up, bond prices go down. Okay? Interest rates are not quite at all-time lows, but they're low. Okay, I think the 10-year Treasury, not to get too specific, is at 2.6%, something like that. When interest rates go up, your bond prices go down. So does that mean I'm telling everyone in this room to get out of bonds? Nope, not at all. Because you know what does well when the stock market doesn't? Bonds. So bonds, let me go back a few. If you look at what happened in 2008, fixed income actually was up 5%, high quality bonds. So Mercer doesn't love bonds, don't think you're going to make a lot of money there, but for a conservative investor, it's very important that you still have ownership in bonds. Because I'll be the first one to tell you I can't predict the market. Bonds aren't going to give you a good long-term return at this point, but in a down market, they will save your cookies. And that's why you own them, for that very reason. Yes, you get some income, and unfortunately that income's not too attractive right now. But when interest rates go up, bond prices go down. But guess what? Yesterday, for those of you who didn't follow, the stock market was down big yesterday. Down about 200 points. I think it was the worst day since July. You know what went up yesterday? Bonds. That's why you own them. Okay? So, hopefully, does everyone understand the benefit of Mercer? It's forward-looking. When something's expensive, we either reduce our exposure to it or we remove it completely. And when something's cheap, we add to it. That's what we're doing all the time. It's not a set it and forget it portfolio. This year alone, we've made 6 trades to try to take advantages of in the market where we see inefficiencies. We're doing that without you doing a thing. Only firm on Wall Street who has Mercer, and we think it's a huge competitive advantage. Any questions on that at all that anyone has? Does that make sense or clear as mud? In between? Okay. All right, so what we do then is we take all the information from Mercer. They tell us what they think everything's going to, what the likelihood of what every asset class. They say, we think real estate, I'm throwing out numbers, don't write these down. We think real estate's going to do 6% a year. We think international and emerging markets are going to do 15% a year for the next 5 years. We think bonds are going to do 2%, blah, blah, blah. So we have some geniuses down at the home office. I'll show you that in a second. This is step 2. We said, you know what, we have all this information from Mercer. Now we're going to build a portfolio for the least risky investor over here, which will have very little stocks in it and mostly bonds. And for the person who wants to say, you know what, I'm willing to take a lot of risk to make a lot of money, but you need to accept a lot of volatility. We have portfolios for that investor over here and everything in between. That's why I say it's very important that you determine what your risk tolerance is. Okay? Because what happens, we've been in a great market for 5 years. What happens in a market like this, it's just human nature. We all kind of get a little bit greedy. Like, oh, we're all making money again. It's always good to reassess exactly what your risk tolerance is, especially in a market like this. Okay? So, we build these different portfolios, and let me tell you who they are. The people down in St. Petersburg who are working for you and for Chad's clients in these portfolios. First of all, our department, AMS, which stands for Asset Management Services, we have now we do have over $120 billion under advisement in our department. This Freedom portfolio, which we're talking about today, has over $30 billion in it. So this isn't some product that was just, came out last year. It's been time tested. Advisors and clients love it. That's why it's worth or has over $30 billion in it. And there's over 200 employees down at the home office working for you and Chad's clients to put together the best portfolios possible. And let me just explain this AMS research stats here. We have a team called Due Diligence. And here's, I think what Chad understood a long time ago. Chad's a very smart guy. Okay, we have a lot of advisors who are very smart, but he's laughing. You're a smart guy, Chad. Take some credit. All right. Yeah. There was some big news. Yeah. She doesn't think I'm very smart, so so, again, Chad talked about today, if you didn't see the news, Bill Gross left PIMCO. Okay, huge news, largest bond manager in the world. Okay, we have a lot of money with PIMCO. Freedom does. Okay? Now, we need to know what's going on there immediately and what to do with the money. So, Chad if Chad didn't use Freedom, Chad, let's say he had $10,000 in PIMCO, he calls up PIMCO, hey, I need to speak to the CEO of PIMCO, what's going on? Click. Nothing against Chad.
They won't talk to you.
They won't talk to you. We have billions of dollars with PIMCO. We pick up the phone, they don't want to lose the money, right? We call PIMCO, we talk to the CEO, we talk to the portfolio managers. Last year alone, our due diligence team met with 227, that's the on-site visits there, different portfolio managers, making sure they're doing the job that we hired them to do. Okay? That's their entire job. Yet these all-star money managers that Chad was talking about are continuing to deliver on the promise that we hired them for. And if they're not, we'll fire them. And in the case of PIMCO, I don't know what's going to happen yet. But I mean, I'm not going to make wild guesses, but it's probably going to be a fire situation. We hired PIMCO because we wanted Bill Gross. If Bill Gross isn't there, we're probably not going to keep that money manager in there. Now, Chad says he has a
question.
Yeah.
Where did he go?
He went to Janus Funds. Yeah, that just came out this morning. So here's another important thing. Chad talked about he has this great track record, and he does. He is the #1 bond manager in the world as far as assets. And he's the, again, I'll use the term 800-pound gorilla in that space. If you pick up Money Magazine, there's an advertisement, PIMCO Total Return Fund. Here's its track record. It's pretty good. You're like, dang, I want some of that. Just maybe call me cynical or skeptical. Do you think there's a big asterisk or red flag? By the way, Bill Gross, who got you these returns, are no longer here. Of course not. You know, they're just selling you on performance. And that's what can be a little scary sometimes. So our due diligence team, it will be all over this PIMCO situation. We have fired managers constantly. If a portfolio manager leaves, we are not confident with the person taking over, we will fire them. Pure and simple. It's the people who get performance. If there's a real talent in somebody and the ability to pick stocks or bonds, that's what we want to follow. We don't want to follow some person who's never done this before because it's your money. Home office visits, that's these portfolio managers and CEOs coming down to Florida where we're located. It's almost always in the wintertime. About 60. Conference calls, 160. Travel days, they travel almost half a year and 100,000 miles. So they are doing the due diligence to make sure we have an all-star lineup of mutual funds in these portfolios for you. Okay? And we will make changes as necessary. Okay, so let me just hopefully just put this into perspective. Mercer gives us forward-looking projections in every asset class in the market. Okay? Let me just say this. Mercer is the biggest consulting world. They don't have a crystal ball. Nobody does. But generally speaking, if you buy something cheap and you hold on to it long enough, you are going to do extremely well in that investment. Right? That's just how markets work. I mean, there's market cycles happen over and over and over again, and they will through time. And if you buy something expensive, it's not going to work out well for you usually. That's the way it works. Mercer's keeping you out of that trap. We're doing everything we can to keep you away from that. But, you know, when Mercer says small cap is expensive, like they did earlier this year, it doesn't mean small cap can't get more expensive for a while. And it did. But since then, small cap is down over 10%. The S&P, which is large cap stocks, 500 largest in the world, year to date is up over 8% for the year. Small cap companies are negative this year. You have lost money if you own small cap stocks this year. That's the benefit of Mercer. Okay? Then we have a team, which is step 2, who builds all these different portfolios depending on every risk tolerance out there. And again, if you don't know what it is, please talk to Chad and you can get one of those investment policy questionnaires. Highly recommend you do that. Step 3 is we search for and hire high quality managers that compensate you for the risk you're taking. That's this team right here that I just talked about. We do that over and over and over again, meeting with these different portfolio managers to make sure they're delivering on the promise. And investment companies will do everything they can to confuse you about who's managing the money. Here's my favorite example. I actually have an investing idol, and I realize that makes me immediately uncool. Has anyone heard of the name Peter Lynch before? Show of hands. You got one, you got two, Chad, 3, 4. That's a good number. Okay. He is generally regarded with Warren Buffett as one of the best investors of our lifetime. Okay? And I absolutely think he's the best investor there ever was. He worked for a company called Fidelity. Most of you have probably heard of Fidelity before. And at one point owned the largest mutual fund in the world, which was called the Fidelity Magellan Fund. Probably back in the early 90s is when he retired. Okay? And the track record of this fund was just unbelievable. It was just, I mean, you couldn't touch it. No one could. It was just that good. And he had just, everyone had just utmost respect for how he invested. He decided to retire. Obviously a very wealthy man, did extremely well for clients, and he retired. But Fidelity was very smart, and they went through an advertising campaign. If anyone remembers this, God bless you. But there was an actress by the name of Lily Tomlin who was in these commercials with Peter Lynch after he retired. So if you're an investor, you're like, oh, Peter Lynch is still there, my money's great. This is wonderful. They actually hired a guy by the name of Brian Stansky after Peter Lynch left. Since Peter Lynch left, Magellan, and this is being kind, has been an absolutely mediocre fund. But again, this is my skepticism of Wall Street, so I understand how they do things. Peter Lynch leaves. Next day, you open up your money magazine. Oh, look, Fidelity Magellan, it's a 5-star fund. Look at these returns, 1, 3, 5, 7, 10 years. This is great, I gotta own it. Let's see, I'm looking from the acronym. There's no asterisk there saying Peter Lynch no longer manages your money. So that's why due diligence is so important, to make sure the person who got you those returns, are they still there getting those returns? Because if they're not, we don't want to do business with them. Nobody pays to be inside of our freedom accounts. No one pays us a dime. It's completely done on, we think this is the best portfolio manager, period. We have too much money invested, as you can see, $30 billion in freedom to fool around with that kind of business. Step 4, so I'm not going to go through all these slides, you're all like, thank God, talks about the ongoing consulting process. One of the things that's extremely important, a lot of you have probably heard this term before, with every portfolio is to do what's called rebalancing. We do it automatically once a year. If you're not familiar with rebalancing is, just give you a quick example. Let's say you're in what we would call a balanced portfolio with freedom account. It's about 60% stock and 40% bonds, okay? Last year, bonds had their first negative year since 1990. You lost 2%. You know, not good, but first year you've lost money since 1990, 2%. The S&P made 30, and stocks went up everywhere but emerging markets. So your 60-40 portfolio, which is what you said you were comfortable with as far as risk, is now 70% stock and 30% bonds. If you don't rebalance your portfolio, you now have way too much risk in your portfolio for what you initially signed up for. So what we do is we rebalance your portfolio automatically back to the 60-40. By us doing that, what did we also just do again? Buy low, sell high. We are forcing you to do that over and over again through Mercer, through rebalancing. That's the one thing I want you to get out of this more than anything, is the hardest decision for every investor to make is to buy low and sell high. Because when something's low, there's a reason. There's a reason why Europe is cheap right now. There was a reason why our markets were cheap in 2009. You should have been putting all your money in our market in 2009. But it was almost impossible to do, right? Because everyone felt terrible about investing. I get it, I did too. But I know, you know, I've been doing this long enough, almost 20 years, that when you're given those opportunities, that's when you need to take advantage of them. And we make you take advantage of them without you having to worry about it. So, in conclusion, what are we doing with this process? It's a comprehensive investment process in a bunch of portfolios. I'll show you in a second. We're putting together portfolios like the world's largest institutions. You're getting the same asset allocation that a Pepsi would get, that Southwest Airlines would get, okay? And you're getting it for $50,000. And someone asked the question once, it's like, wait a second, how is Raymond James the only firm that has this? And what does Mercer just give you this? No, we pay for it. We think that this is so important to the success of the clients of Raymond James that we're willing to pay Mercer a good amount of money to get their information. It's not like Mercer just is friends with us and said, yeah, we'll give you all our intellectual property. No, we pay for it. But we think it's well worth the money. Stringent quantitative and qualitative mutual fund process, ongoing reviewing of the holdings, and/or rebalancing, and of course you get performance reporting. Here's an example of what the portfolios look like. If you guys want me to turn to one you can see, that's the balance with growth allocation, which is 73% equity, stocks, 17% fixed income, and 10% alternative investments. Alternative investments, if you're not familiar with, are generally investments that are there to help protect you in a down market. Our thought process, and you may agree or disagree, people set long-term goals for themselves. If you sit down with Chad or whomever your financial advisor may be, generally most people's goals aren't to, I want to beat the market every year. Okay? You want to get to retirement. You want to, again, save for a wedding, whatever you may be saving for, a child's wedding, whatever. Okay? So the use of alternatives is done so when you have a bad market, we do better on the downside. We protect you on the downside. Because what happens if you lose too much money in the market? You get scared, and you panic sometimes, and you get out of the market exactly the wrong time. So my point in saying all this is, let's say the market was up 30% last year, and we're up 27%, we're okay with that. Hopefully you are too, 27% is great. But what we're trying to do is if the market's down 10 or 15, we're going to try to protect your assets as much as we can on the downside, because that's what keeps you from making that, what we think, rash decision of getting out of the market exactly the wrong time. Okay? But that's what a portfolio looks like. This is it has large cap, 33%, mid cap, which is just a little bit smaller companies, 12%, small cap, very small companies, non-US developed markets, that's developed international, the Nestle's, the AstraZeneca's, emerging markets, 4%. This actually hasn't been updated yet. It's actually now 6%, because we made a trade recently. That's not updated here. Fixed income, investment grade, 12%. That's not accurate anymore, because you see 3% in non-investment grade fixed income. That's high yield. We removed all high yield in this portfolio. This portfolio no longer has any high yield in it.
Junk bonds.
Yeah, junk bonds. We think they're expensive. So a trade that we recently made, which isn't reflected here, we took all high yield out of this portfolio. We don't think there's enough reward potential for the amount of risk that you're taking. So we said, you know what? We'd rather put it all in high quality bonds. And if the market has a day like yesterday, we're going to protect you with that money. Alternative investments include a little bit of real estate. And then we put a little bit of cash in the portfolio, 2%. That's a standard portfolio, but as you can see, we have a lot of different choices. If you want equity income, you want to just get a check every month, we can yield you almost 4% with an equity income portfolio, diversified portfolio of equity income, global equity. Man, if you want to really tee it high and let it fly and take some risk, we think that's the portfolio you're going to make the most money in. Global, it's also going to be the most volatile portfolio that we have. Any questions, unless you'd like me to read the disclosures? I'm happy to do that. Questions on anything?
What are the average fees when you create an account?
Chad, I'll let you handle that.
They vary. Each one is different. I discount, and I'll tell you my reasoning for that. When it's all broken down, I would say on these 1.7 is where they start, but usually I break them down and get somewhere in the 1% range. Yeah, 1.2, depending on the assets.
Yeah, there's no commissions here. There's no loads to get in or get out. If Chad says like 1%, that's it.
And you see it come out. Yeah. It's with these free. One thing I like about it is the transparency of it. Once a quarter, you see that quarter's fees come out the back door. I mean, it shows up on your statement, every penny of it. There's no question of, is there something hidden? It's all there, and it's all laid out. Now, I've got clients that hate that. I've got clients that wish that it was hidden. You know, if you're sitting there, let's say it's a 1% fee, so I can do the math in my head, and you got $500,000 sitting there, and you're pulling 1% out, well, that's $5,000 a year. So you see $1,250 come out every quarter. Would you rather see that $1,250 come out, or would you rather just forget it? And I've got some folks that cannot handle seeing that fee come out. That were in Freedom, loved the performance, loved everything about it, but hated seeing that fee. We went back to regular mutual funds. You know, fees are the same. Actually, Freedom's a little cheaper. And you get all the rest of it. But they don't have to see the fee. It's hidden from them. Because on just about every investment out there, there's either a fee you can see or there's a fee you can't see. And that's the bottom line on it. Now, one thing I do want to, one little chart I want to draw. This is real simple. Y'all don't laugh at my artwork. Anybody familiar with a yield curve? This is to break down everything he just said on a yield curve. Whether you go this way, the more risk you have. The higher you go, the more return you have. The markets fall about right here. So if you draw a line, if you can get to here, it's worth it to take this much more risk to get this much more return. Everybody agree? But is it worth it to take that much more risk to get that much more return? And it's usually not. And that's simple, but that's where we're trying to get to. The whole presentation opens the hood of the car, and he shows you everything under the hood and how the engine works and how you get to it. At the end of the day, we're going to shut the hood, we're going to crank the car, we're going to drive off. But if we can limit your risk, if you just look at returns, and let's say that this portfolio that falls right here on the risk and return does 9%, and this one has way more risk, does 9.5%, which one would you rather be in? I'll give up 0.5% to give up that much return. It's questionable, depending on your situation, to whether or not you ought to drop back to this one to get that much further back. There are some folks that don't want risk at all. They want to be down here. Let's say half the risk of the market, a third of the risk of the market, and not worry about trying to get extra returns. You know, the lady I mentioned earlier, we're in the extremely conservative Freedom portfolio for her. It falls way down in here on that risk to reward yield. We're not trying to make her tons of money. We're trying to protect the assets she's got and grow them gradually over the next, who knows how long, hopefully years and years and years and years. But everybody's different. So the amount of risk that you can take falls on this chart. And y'all don't have to worry about all that. This shows you how we do what we do. The main thing is we figure out where we are, figure out where we're trying to get to, and we build the safest portfolio we can that should get us to that point. And that's the gist behind allocations and portfolio planning and all of that. Now, this isn't the only product that we have at Raymond James. This is what we wanted to talk about today. I mean, but there's no, I have portfolio managers that I can bring in where you don't own mutual funds, where you actually own individual stocks. You know, they usually have a higher minimum, but I can actually bring the manager in. For example, we've got one group of 3 managers. It's a $300,000 minimum to go to them. They're large cap dividend paying managers. They blew the top off of it last year. Blew the top off of it. Beat the market by average of about 5% above what the markets did. They did great. But I can't take a client and put all their assets in large cap dividend payers. Because if large cap dividend payers get hit next year, guess what's going to happen to these managers? They're going to get hit. You need some of that in your portfolio, but you've got to have the diversification. Because we're not trying to knock grand slams every time we step up the bat. You know, if we can hit doubles and we can hit singles and a triple every once in a while hit one out of the park, then we'll be fine in the long run. Because it's not about tomorrow. It's about 3 years, 5 years, 10 years. It's about your children. It's about your children's children. You know, it's about that legacy, protecting those assets, and not having to worry about it every night when you lay your head down. I mean, so you know, in a nutshell, that's what we try to do. And, you know, and we answer the telephone when you call. So, any other questions? We actually got about 15 minutes before we're supposed to be out of here. But I'm gonna be different than my high school teachers. I'm gonna ring the bell. So, if y'all need anything, questions later on, did everybody get one of my cards? My cards are tied to these neat little goodie bags that my